market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London for Francine Lacqua. Let's begin with the latest out of Washington. President Trump saying he's preparing to impose tariffs on cars, chips, and pharmaceutical imports of around 25% as early as April 2nd. On the geopolitical front, in the meantime, the U.S. president saying he will, quote, probably meet with Vladimir Putin by the end of the month, following a meeting of top U.S. and Russian diplomats in Saudi Arabia. A lot to digest. Let's discuss with our Brussels bureau chief, Kevin Whitelaw, and our Bloomberg's senior writer, of course, Putin expert Stephanie Baker as well. Kevin, I want to start with you specifically because the narrative just 24 hours ago was that U.S. and Russian officials are meeting in Riyadh. European leaders are meeting in Paris. One got a little bit of some sort of consensus, I want to say, in Riyadh, and that perhaps the ties are indeed thawing. Did we get anything out of Europe, and what might we get in today's summit?
Well, I think what we have today is sort of a meeting of, I guess you'd call it the European leftovers. So it's the leaders that weren't at the first Macron-convened summit earlier this week. What Europe is trying to do is figure out how to just begin to react to what has been just a stunning set of moves and reversals of U.S. policy and a sudden sense that the U.S.-Russia conversation is moving very fast, and Europe is simply not there and is not able to defend its interests or Ukraine's interests. But it is very challenging for a 27-member bloc that is supposed to act with unanimity to be able to move anywhere near the speed that Trump has so far been moving at. So they are trying to get sort of on the same page, but ultimately they're going to have to figure out, is there a way that they can insert themselves constructively into the process to be able to make sure that Europe is represented, or has this train already left the station?
Stephanie, weigh in here, because you, of course, are not only an expert on all of this, but have written a book called Punishing Putin as well. There is a narrative right now that are these the early signs of some sort of rehabilitation of Russia in the global economy, given that after Riyadh we talked about, or at least heard headlines around potential thoughts of increasing embassy staff on both sides, and even floated the idea of removing sanctions. What do you make of that? Is the rehabilitation of Russia coming down the pike?
Yeah, it certainly looks like that. We're witnessing a historic shift in U.S. relations, not only with Europe and its support for Ukraine, but the isolation of Russia, which has been in place intensively in the last 3 years, but really since 2014. And, we had Rubio say that he was looking for increased geopolitical and economic cooperation with Russia, which is quite a stunning statement to make, while Trump is threatening tariffs on the rest of the world. Meanwhile, you have the EU, which just rolled out its 16th package of sanctions on Russia. So it just shows the stark divide across the Atlantic on where do we go with Russia relations.
Absolutely. The schism between the transatlantic alliance, schisming even more, if that's even a word. Kevin, come back in here as well, because Stephanie used that key word, which is the economics of it, really bring in the idea that oil may be a key piece of this. When it comes to Europe, we are a couple of days away from the German election. How exposed is Germany to the temptation of cheap energy out of Russia? Is Germany potentially the front line of this conversation of rehabilitation that we were just talking about?
I mean, up to now, there's been zero interest from the mainstream parties in Germany to sort of go back there, and a pretty widespread understanding that the sort of energy picture has been changed forever. I think Europe, with the proximity to Ukraine and Russia, has learned its lesson a little bit that there is no rapprochement with Putin that's going to work for them. But, keep in mind, you still have, obviously, in Hungary in particular, but also in Slovakia, you have leaders who are interested in bolstering ties with Russia and see some real advantage in some of the cheap energy that comes from there. But, the German election is going to be interesting. We're going to see how the far-right party does in that election, and that could start to shift the conversation one way or the other as we sift through those results.
I mean, Kevin there was talking about the energy picture, Stephanie. When we're talking about sanctions specifically, there's so many kind of levels and iterations that have come out from Washington and the EU sanctions package. If there was wiggle room, an early sign of an olive branch with Russia, where in that package might it be?
Well, you know, the Biden administration rolled out these tough sanctions on Russian oil 10 days before Trump entered the White House, which included sanctioning 180 vessels and sanctioning 2 major oil producers in Russia, as well as oil service providers and traders. So you could see some lifting of sanctions on Russian oil, which is remarkable because the EU today just rolled out additional sanctions on tankers. So actually, you know, early on, even just a couple of weeks ago, Trump was talking about possibly ramping up sanctions on Russia. And we thought perhaps he could increase sanctions on Russian oil to extract more concessions from Putin at the negotiating table. It seems like now they're ready to just give away everything without getting much in return. So I don't see much of a strategy here in terms of using sanctions as an effective bargaining chip, which they could be if deployed accurately.
Kevin, I want to give you the final word here. Stephanie was just talking about the sanctions package. She mentioned that the EU has a tough one. What levers can the EU pull here if you do see this policy divergence with the United States?
Well, you know, obviously the EU doesn't have to lift sanctions just because the U.S. does. But up to now, for the past 3 years, the U.S.-Europe coordination had simply never been closer. And they really coordinated all of these sanctions packages, the oil price cap, the various enforcement mechanisms. It had been absolutely as close as it had ever been in terms of their ability to work together to try to put pressure on Russia. And obviously, if the U.S. decides, even if it doesn't lift sanctions, if it even decides to simply stop enforcing them as strictly, that is going to make it a lot harder for the EU to go on its own on all of these. But up to now, at least, they are pushing ahead. And the interesting thing about this is, you know, EU sanctions do require unanimity, which means even Hungary, which, you know, has talked about aligning itself with Trump, did agree to the 16th sanctions package, which was provisionally agreed to today.
A fascinating story. We'll see how it all unravels, of course, as we have that meeting for the second day in Paris with some of those European leaders. Our Brussels bureau chief there, Kevin Whitelaw, and our senior writer, Stephanie Baker, and author of Punishing Putin, walking us through what is a truly historic moment in terms of what could be a reset in the U.S.-Russia relationship that arguably leaves Europe out. Lots of geopolitics to digest. Let's talk about how it affects these markets. Peter Oppenheimer, Chief Global Equity Strategist over at Goldman Sachs, joins me around the table. Hello, good morning.
Good morning.
Lovely day to have you.
Thank you.
We're talking about these geopolitics. I feel like the roadmap for the markets could be perhaps seen in what happened in 2022 with oil prices, with aluminum prices, with the equity markets getting that exposure and the inflation worries around there. Why are we not seeing a bigger market reaction this time around?
Well, I think in many ways the context is very different because then, as you say, we were seeing a surge of inflation and rising interest rates, and that was raising concerns about recession globally and all the consequences of higher rates on lower investment. Now we're in an environment where there's a lot of confidence that global growth will continue, even in Europe, and inflation and interest rates are moderating. So the setup from a macro perspective is more positive. But I think also it's important to say that context matters a lot here. You know, coming into this year, Europe, which is now seeing, from a stock market perspective, quite a strong rally, was very heavily seen as likely to be the worst performing market this year. There was huge confidence in the US, given a more pro-growth agenda. But at the margin, some of the things we're seeing are looking to be a little bit more supportive for Europe. And therefore, from a low base and from much lower valuations, you're seeing quite a strong rebound as risk premiums start to moderate a bit.
Is that a rotation? Is that a temporary moment in the sun, a sigh of relief? Or does this European green on the screen that we're seeing, specifically in the DAX, by the way, which is blowing everyone else out of the water, is this temporary?
I don't think it's temporary. I wouldn't say with confidence that Europe is going to sustain the scale of outperformance that we've been seeing since the beginning of this year. But we should say, look, Germany has been performing quite well despite a very weak economy for some time now. Again, it got extremely cheap. And now you're seeing the prospect potentially of higher energy prices coming down, risk premia coming down, and also to some degree the external pressures that Europe is being put under is creating a kind of forcing mechanism for some kind of change. We'll see To what extent that comes through in policy, the German election there will be important in terms of potential easing of fiscal policy. But from very, very low expectations, things are improving. And we should say that pockets of Europe, despite the economic challenges, have been doing very well for some time now. You know, in the last 2 or 3 years, European banks, which were one of the worst performing assets for a decade after the financial crisis, have been performing as well as the Magnificent Seven in the US for some time now, rather quietly because they're much smaller and get much less attention. But fundamentally, you are seeing some improvements in Europe coming through.
Fascinating. I have so many more questions to ask. I'm going to ask them to you in just a moment. Peter Oppenheimer from Goldman Sachs isn't going anywhere. I still have plenty to pick his brain about. But stick with us. We're going to dive into that geopolitical and market narrative, how they're interrelated, how they may not be. That conversation next. This is Bloomberg. Seeing a little bit of mixed reaction in those European equity markets. The FTSE 100 on the back foot this morning, despite the fact that we've seen a massive rotation into Europe. Green on the screen for the last 5 weeks or so. This, of course, is as we all digest the geopolitics. We digest the tariff threats coming from the United States, not to mention ECB cuts down the pike and a little bit, perhaps, of economic resilience kind of peeking through, I say, with it through the clouds. And I should mention a German election just a couple of days away. To dive through that laundry list of factors, Peter Oppenheimer, Chief Global Equity Strategist over at Goldman Sachs, still here to give me maybe an explanation of what is going on. I mean, look, we talked a little bit about this valuation gap, this term premium before the commercial break as well. Why now? Why Europe now? When the consensus is still very much that Europe is headed for stagnation, Europe is headed for weakness, why is it having its moment now and not 6 months ago?
Well, I think the issue here is context and what had been priced. So in a way, the critical thing for risk assets, equities in particular, is not so much the actual outcome, but the outcome relative to what the market had been pricing. Over the last couple of years, you'd seen a massive divergence of economic growth between the US on the one hand and Europe and indeed Asia on the other hand, and also a big gap in relative profit growth. Europe has stagnated for a long time. And we're now beginning to see some resurgence of optimism about the relative prospects. Now, Europe is still seeing much weaker economic growth than the US, but coming into this year, there was a record 40% discount in the PE between the US and Europe. So expectations were very, very low. And as we were discussing before the break, we're moving into a period where very high risk premia in Europe is beginning to moderate a bit. The prospects of high energy prices coming down are improving, and that was one of the factors that had been a big headwind for Europe. And also we're starting to get some sense of Europe pulling together and potentially also enacting its own reforms, both fiscally and indeed on defence, and that's creating a little bit of optimism from a very, very low base.
Is the bull case for Europe the same bull case as China, in that you have suppressed valuations, you have this almost fiscal backing or expected fiscal backing? Is it one and the same, the European story and the Chinese story right now in terms of stock exposure?
Well, it's similar because, again, China and Europe were the two areas that people were looking at as having the toughest structural backdrop, both economically and in terms of potential profit growth. And they had gone to record low valuations relative to the US. There are triggers in both cases. I think that, you know, the DeepSeek news in China was one of the things that's dampened a little bit of enthusiasm for the dominant tech stocks in the US. They're still doing well, but not outperforming to the same extent. And it's reignited some interest in China. And China as well, from a political perspective, seems to be warming to the private sector. People were worried about that previously, and that is corresponding with a period in Europe where, again, there's a little bit more appetite, it seems, for reform and really to find ways of triggering stronger growth and also the potential benefits that might come from both lower interest rates and lower gas and energy prices.
It's a very optimistic take because there is also a line of thinking out there that you're about to get higher interest rates, specifically out of the United States, if you do see an inflation uptick, and higher energy prices, largely in Europe as well because of the gas storage issues, and perhaps a less of an inclination in this part of the world if we do see some sort of rehabilitation of Russia to lean into that economic relationship. Where is that being priced into this market, that possibility, if at all?
Well, I think, firstly, we should say that there's not a lot of risk priced into risk assets in general. You know, if you look at equity risk premium overall, they're relatively low. Look at credit spreads, very, very tight.
Yeah.
So I think the markets in general are pricing a lot of relatively good potential outcomes, and they're not really pricing shocks. But that's not specifically true, I think, for Europe.
That sounds like complacency around tariffs. Am I reading that right?
Well, I think what increasingly has happened is that the worst fears about the potential for tariffs are being moderated. You know, some of the tariffs announcements that we're hearing sound very significant, but they're not as bad as people potentially thought they could have been a few months ago. And also, increasingly, I think people are looking at tariffs as a potential leverage or bargaining tool rather than a permanent set of changes.
Yeah.
And again, that, I think, at the margin relative to what was priced is a positive.
All right. Peter Oppenheimer, Chief Global Equity Strategist over at Goldman Sachs, walking us through what that bull case of Europe may actually look like. Maybe the moment in the sun is more than just a moment. We're going to dive into those details throughout the rest of the program. Coming up, HSBC planning to cut expenses by $1.5 billion a year while announcing a $2 billion share buyback. We're going to break down the details next. This is Bloomberg. A complete 180 for HSBC shares, flat this morning after having a little bit of a hiccup earlier in the session, now higher by 0.2%. They did report fourth quarter pre-tax profit of about $2.3 billion. They beat estimates. Let's break down the details here. Tanuja Netzel, senior banks analyst for Bloomberg Intelligence, joins me right here on set. You were here 30 minutes ago, and we were talking about an almost 4% drop in HSBC. We were seeing a really big drop because of perhaps some concerns around the cost-cutting measures, et cetera. What do you think has changed? What is the market perhaps seeing that we didn't 30 minutes ago?
Well, first of all, I think it's important to highlight this HSBC story as like a travel versus arrival. The stock has been running for more than 30% since August. It has arrived to the level it arrived. Today we had earnings. The price of the HSBC is more or less near the price target projected by the analysts. So today earnings, there were strong earnings. 2024 was quite a good year for HSBC, and the cost-cutting plans was a little bit less than I think market anticipated. 1.5 billion is a good number, but maybe it's not enough. However, no ROT and CT outlook for the bank suggests that they will be able to continue distribute to the shareholders.
I'm a little confused about the cost-cutting measures because traditionally when you look at these cost-cutting measures in a very big way, they're viewed as either an extreme positive or an extreme negative. Very quickly, walk us through maybe where HSBC needs to do more, the nitty-gritty of it.
So this 1.5 billion will be spread over the next 2 years. So 300 million will be delivered in 2025. Next phase will be 2026, and the rest will be delivered in 2027. Costs to achieve are about 1.8 billion, so it proves how expensive it is to cut costs. Most of this possibly will be coming from wages. So they estimate that this 1.5 is around 8% of wages and salaries, so it suggests that there will be some job cuts, but we don't know exactly how much job cuts will be happening in HSBC. CEO stayed away from giving us any numbers. So what we're going to see is we're going to see 1.5 billion savings from other businesses to boost the profitable businesses. So they're going to move away from Europe and invest more in Asia.
Certainly something we're going to keep an eye on. Tanuja Netzel from Bloomberg Intelligence watching us through the HSBC story. This is Bloomberg. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. These are your top stories. Another round of tariffs. President Trump saying he would likely impose them on imports of cars, semiconductors, and pharmaceuticals as soon as April 2nd. Meantime, the U.S. and Russia moved to revive ties as Ukraine left out of peace talks in Riyadh, raising the possibility of removing sanctions and increasing embassy staff. Plus, traders keeping bets on BOE rate cuts for the year fairly unchanged, despite the UK inflation hitting a 10-month high. The pound pairing some of its earlier gains. In the meantime, let's focus on the big story here. We are 4 days away from the German election, Europe's largest economy heading to the polls, with the government's attitude to public spending and public debt a key issue for voters. Now, at stake is whether the next coalition could loosen Germany's so-called debt brake and even open the door to joint borrowing at a European level. All over the stories, Bloomberg's Oliver Crook, our correspondent based over in Berlin. Ollie, the debt brake, we know, has been an issue at the heart of the German political and economic debate for a while. How do we proceed from here?
Yeah, so listen, I think there's a big question about what Friedrich Merz's sort of ambition around the debt brake is going to be. Every now and then he sort of opens the door to saying, you know, maybe we'll be able to look at it, to revise it, to maybe do some workarounds, and that is going to be absolutely crucial for this next mandate. As we know, the SPD and the Greens have wanted to reform the German debt brake for a long time. And just a reminder of what the debt brake is, it restricts basically debt to 0.35% of GDP in terms of excessive debt. That means that Germany has one of the lowest debt to GDP ratios of any sort of developed economy across the world. It's about 60%. The United States is over 100%. You know, Japan is like 250%. So there's this huge sort of fiscal room for the Germans to invest if they were willing to basically move on the debt brake. The question is, what do you do with that money if you decide to sort of to move forward with it? I think the number one priority right now for the Germans has got to be defense investment. This is something that we've been talking about a lot over the last few days, something we're going to be talking a lot about over the many sort of months to come in the light of the Trump administration. But of course, it would also stimulate a lot of these German companies like Rheinmetall, a lot of these defense companies, where we're seeing a sort of failure on the commercial industry side, the auto sector and the other sort of big industries like chemicals. Could some of that be made up with some of the defense spending? And that is the kind of room that the debt brake would sort of allow. But of course, they also need infrastructure investment in the trains, in the grids, and in energy generation, all of these sorts of things. And the question is the CDU, which is likely going to be the sort of main protagonist in the next government, willing to make that decision? That is still a sort of undecided, and Friedrich Merz going a bit back and forth on that.
It's a fascinating one. Ollie, 30 years ago in the European countries, the 27 European countries adopted the euro, Germany was slow to do it. They were dragging their feet. You've seen that same sentiment when it comes to joint debt issuance as well. Now that we've seen a complete sentiment change in terms of policy from the United States, a need to invest in defense, are we seeing that stance thaw a little bit?
So listen, some of the things that we're hearing is that potentially Friedrich Merz is something that he's beginning to sort of look at in terms of, you know, conceptually, could there be a conversation at the European level on joint debt? As you know, Kriti, this is one of the most sensitive issues among the sort of European Union, certainly among the frugal nations, among the Netherlands, many of the Nordics, but of course Germany. And Germany is basically the sort of main protagonist on the question of joint debt. If Germany were to get on board, it certainly could have a lot of the other sort of countries follow. The question is, again, I think that this is sort of a very sort of unique moment for the European project. It is sort of caught between China and the United States. And the real question for the Europeans going forward, and this is the fundamental question put forward by the Mario Draghi report on how to make Europe more competitive, is European integration going to expand? Are they going to be willing to make those sort of difficult decisions? And for Friedrich Merz, if you think about it, if he comes into office as Chancellor of Germany, as he's expected to do after the vote on Sunday, if he is willing to come to Brussels, to that table with the sort of joint debt chip in his hand and saying, basically taking a leadership position in Europe, that will give him an enormous amount of power, and Germany an enormous amount of power in terms of shaping what the European project could look like going forward. But again, we shouldn't sort of undersell how difficult that conversation is in Germany, how difficult it is among the Nordics. But again, if you think of this moment as a sort of moment of destiny for Europe, is Friedrich Merz the man that would be willing to grab that mantle, take that leadership position, and potentially make those very hard compromises to make the European project more integrated?
We'll see if this is the push, the final push that maybe the Europeans need to scramble into action. Bloomberg's Oliver Crook in Berlin walking us through the questions ahead of that German election. We are 4 days out. We, of course, will bring you all the news, analysis, and market moves that you need to know as we continue to build up to that polling this week, including a special program when the polls close on Sunday. That, of course, live from Berlin. In the meantime, let's talk about the broader geopolitics. Bloomberg has learned that the EU is working on a plan to provide Ukraine with more military support as soon as possible. Meanwhile, President Macron has convened a second meeting on Ukraine and European security. It all comes after EU leaders in Kyiv were sidelined from talks between the U.S. and Russia. Joining me now is the acting director for the European Leadership Network, Jane Kinninmont, joining me right here on set. Jane, before we go into these talks, you have just come from the Munich Security Conference, which was kind of this big, staggering alarm bell for so many European leaders. Walk us through the sentiment on the ground. What did you feel was the immediate reaction from some of these folks?
Day one was dominated by J.D. Vance because European leaders were waiting for him to talk about Russia, Ukraine and NATO, and he did not. He lectured them about their democracy and then went to meet with Germany's far-right party leaders. So there was actually a shock about the lack of consideration for Europe's security preoccupations. Day two was focused on Zelensky and his rallying call for Europeans to work more together. And the rest of the conference really was about trying to do the defence maths. This is where we come back to that German debt issue. I think next year's Munich Security Conference will need to have a lot more economists there.
Oh, interesting. Is that a viable plan? I mean, we're hearing a little bit as Ollie was just talking about getting rid of the debt brake, talking about joint debt issuance. These things take years to get there. Is that fast enough as the U.S. is less than 100 days into this new administration and is already making some pretty big moves?
Absolutely. And another thing that was going on in Munich was quite a lot of self-flagellation, which Europeans are good at, with many people saying, wow, we should have woken up to this earlier. We should have started ramping up defence spending more quickly. Of course, all European countries have been increasing defence spending, but it's tough because people are still paying their post-COVID bills and there are so many bits of social spending that matter more to voters. So I think there will be a wider push to increase debt ceilings, because who wants to tell their voters you can't have this healthcare thing because we need to send weapons to Ukraine?
Yeah, I mean, that is, of course, the economic conundrum, the catch-22 that so many of these European leaders are certainly facing. As we're speaking, Jane, I just want to bring our audience live pictures, I should say, of Sergei Lavrov, the Russian foreign minister, currently addressing the Duma after his talks with the United States in Saudi Arabia. Those talks yielding, at least the readout from the United States side, a potential easing of sanctions. Not yet, we're not there yet, but floating the idea of what that might actually look like and increasing embassy staff on both sides of that relationship. Jen, I want to bring you back into the conversation here. What message does that give to the Europeans?
Europeans feel that they're being sidelined and their concerns are being ignored. Now, we should take a step back and say, actually, in the long term, it's not unusual for the US to meet bilaterally with Russia. They did that with the Soviet Union. And really, after the Cuban Missile Crisis back in the 60s, when the world came to the brink of nuclear catastrophe, the leaders took away the lesson that these nuclear powers need to talk. So in a way, there shouldn't be an overreaction to US-Russia contacts. But the concern is that it's come also as the Trump administration seems to be realigning over Ukraine, putting a lot of issues about Ukraine's future on the table without Ukraine being involved or having any buy-in. And people are worried it will mean imposing a peace that Ukraine doesn't like and Europeans will have to police without having any say. That's not really going to fly.
It's not going to fly, but also what can the Europeans do about it, especially as, I mean, the timing is everything here. In the last few weeks, we've seen the Baltic nations come off the Russian electricity grid. We've seen Germany trying to pull out of those Russian kind of natural gas flows, Austria even trying to get rid of that economic relationship as well. Is this an early sign of a rehabilitation of Russia? And is that an economic relationship, if it does indeed proceed and grow, one that circumvents Europe?
There may be an economic rehabilitation of Russia, but I think Russia's neighbours won't buy into it in the same way. And even Germany, having had the big project of Nord Stream 2, where they thought economic interdependence with Russia could help bring about peace, they're now thinking that economic ties with Russia could be a source of vulnerability. So I think out of self-interest, they won't be looking to go down that road. But there are lots of questions about European enforcement of sanctions, especially when it comes to oil. So there are more things Europe could do if they did want to tighten things.
Well, walk us through that. Walk us through the levers here that Europe can pull. I mean, we had a guest on at the top of the show talking about the fact that the EU has recently put on another round of sanctions as the U.S. is floating the idea of taking them off. What else can the EU do here to put their foot down?
There are several things, and the main thing they've been talking about over the last few days is about trying to get forces together, perhaps even offer peacekeeping troops. That's something Keir Starmer has talked about, although so far Russia has said that that's not acceptable to Russia. But we'll see where that goes. But of course, the EU traditionally, what it's been about is soft power. It's been about bringing the rest of the world on side. It's been about helping countries with trade, development and reconstruction. So that's going to be part of it as well. And it can look now at fast-tracking Ukrainian membership into the EU as a clear signal that even if the US vetoes Ukrainian NATO membership, Ukraine would have a future where it's integrated into the rest of Europe.
We had an EU commissioner earlier this week saying that those conversations can happen in the first half of this year alone. I want to come back to the peacekeeping force. You mentioned Keir Starmer has been very vocal, saying, you know, we can have these forces on the ground if we have American security guarantees in the background. There are reports that Emmanuel Macron is trying to literally rally the troops in Europe as well. But a lot of pushback from Spain, Italy, Hungary, Poland, Germany as well. How does Germany fold into this at a time when there is a leadership change in question domestically and internationally? What can Germany offer Ukraine right now, given that historically they've been reluctant to provide things like Taurus missiles, for example? They're pushing back on peacekeeping forces. They do have that economic reliance that still exists a little bit on Russian natural gas. Walk us through the Germany-Ukraine relationship.
Well, this may all be about to change because of the German election. I mean, what we've seen with Germany this week is that Olaf Scholz has objected to the idea of peacekeepers, saying, hang on, it's too early to talk about this. There isn't even any peace to keep. But, of course, there can still be discussions about what Europeans could offer, because if you don't have any peacekeeper implementation, then it's really difficult to see how a ceasefire can hold in the long term. Now, we're not anticipating that there would be a peace agreement that will resolve all the issues anytime soon. Russia has quite maximalist demands. Ukraine is going to find it pretty difficult to go along with what the US is asking, but there could at least be something to stabilise the line of fighting. And there you do need a combination of troops and also international monitors. There may be a monitoring role for the Organisation for Security and Cooperation in Europe, based in Vienna, which helped monitor the previous ceasefire with Ukraine. So there are options that should be being discussed right now and put forward to those that will be negotiating.
Ceasefire in Vienna, exactly where some of those OPEC conversations happen as well. How convenient. Jane Kinninmont from the European Leadership Network walking us through the geopolitics at play and very much how the energy conversation seeps into all of it. Coming up, we continue that with a little bit of a different life. AI causing a two-tier economy to emerge in Europe. That's the view of Amazon Web Services. There's an energy component there as well. We're going to speak to the company's managing director for EMEA next. Stick with us. This is Bloomberg. Now, 42% of European businesses are now consistently using AI. That is on track to hit the EU's target of 75% by the end of the decade. It's according to a new report from Amazon Web Services. But the firm warns the AI adoption is creating a, quote, two-tier economy between startups and larger corporations. The company's EMEA managing director, Tanuja Randery, joins me right now here on set. Pleasure to have you on the program. Thank you so much for joining me.
Thank you.
It's fascinating that we're seeing us get to those EU targets in an area of the world that has the strictest regulation on AI right now. How do you tie the two together at a time when the U.S. is deregulating and Europe doesn't seem to be?
It is really encouraging, actually, and thank you for calling out the stats. You know, we are seeing an accelerated adoption in Europe compared to last year. In fact, the number of firms that have increased their use of AI has increased by 27%. So it's really quite encouraging indeed. And in fact, we think that if we can get to near AI adoption across Europe, we could unlock something like over 400 billion euros of economic value by 2030. However, you're absolutely right. There are a few things that we need to be worried about in Europe and ensure we address. The first is actually more around skills and making sure that there are enough digital skills available to large companies and small companies. And that's where you see a little bit of that two-tier economy emerging. And then the second one absolutely is regulation. We need to make sure regulation is simpler, more consistent, and lower cost.
I want to get into the nitty-gritty of both of the factors that you just mentioned. You talked about large-scale AI adoption. What does that actually look like? Is that ChatGPT telling me everything about the person I'm just about to meet? Is that scripting? What does that look like? What does AI adoption look like for a mass consumer?
Yeah, well, I mean, look, people use AI very differently. Businesses use them differently, as do governments. The thing about this technology that is so transformative, actually, is that you can use it to augment or accelerate or automate any process, any industry, any sector. And that's what makes the usage so broad brush, right? So let me give you maybe two examples to bring it to life. On the one hand, you've got companies like BT Group, and they're using AI to help their software coders be more efficient. And we used Amazon Q, which is our Q developer tool, with them to launch within the first 4 months 100,000 lines of code. What does that do? It removes 12% of tedious tasks away from those coders so they can spend their time on the more difficult tasks in coding. So that's one example, extremely large company. Another example, which is really important for us because it's healthcare oriented, is a startup in France called ECOP. And the way what they're doing is it's almost like a magic button. They're actually taking very complex medical data and transforming that into regulatory documents. And what does that do? It reduces search time and document transformation time from months to seconds, bringing medical devices and drugs to market faster. So very different use cases, but it isn't about a chatbot, actually. I think the real usage of AI is when you see startups embedding it into developing new products. You see large companies using it for productivity enhancements. You see complete shift in customer experience, actually, for you and me, both, as we book online travel and various other things.
I look forward to using it for my online travel. Maybe they can do my expense reports as well. I think it's fascinating here, though, that we're talking about where that digital skill pipeline actually comes from at the same time that we're having the likes of Larry Fink, for example, at BlackRock, having an early warning that AI is going to kill, basically, the labor market, or at least make it a little bit more efficient, that you need less labor force participation. And at a time when we had the U.S. jobs market very tight, that was a great solution. How do you balance the two? Hiring to create a technology that almost eliminates jobs. How do you wrap your mind around that?
Look, we've always believed and have seen that technology has created more jobs than actually removed jobs. And in fact, if you go back 140 plus years of technology transformation, you will see what happens is the really sort of mundane tasks and repetitive tasks get managed by these technologies. And then you're able to actually release the capability of human beings to be able to do the higher value-added things, right? And I think so our conviction around this is AI is going to help us be much more effective, efficient, and drive innovation and growth, which is what Europe needs right now. And I actually think nurturing what we're seeing startups doing, getting large companies to move to being like startups, embracing and adopting this technology will be super important for us to actually ensure that we are continuing to be incredibly global and competitive on the world stage.
So one of the concerns around kind of going full gear into that, specifically in Europe, are the input costs. And electricity and natural gas is one of the big ones, especially as over in the States, these massive data centers are being built, these AI data centers, they're straining the grid a little bit. That's driven by natural gas, et cetera. Those resources aren't readily available in Europe. How does that AI build out work if there's concern around resources?
Look, power is an important challenge, no question about it. And we are constantly looking at all of our data center infrastructure so that we can continue to fine-tune the energy consumption, the water consumption, by the way we design our chips are also in order to be much more energy efficient. In fact, not us saying this, third-party research will say that the Amazon data centers are actually 4x more energy efficient than your average on-premise data centers. We're also, by the way, the largest buyers of renewable energy in the world. We've kicked off and launched over 200 solar and wind farm projects to make sure that there is enough of this. But it's a challenge we have to continue to monitor. And we are, Amazon and AWS are fully committed. In fact, in 2023, we matched 100% of our energy consumption globally with renewable energy.
It's a fascinating one. Certainly we'll see if it actually helps or hinders the case for AI when a lot of folks are very excited about it. We just saw this, the AI summit in Paris. Tanuja Randery, EMEA's managing director over at Amazon Web Services, talking to us about that AI build-out. Coming up, we're going to recap the ongoing rally in European defense stocks as traders expect even more military spend. That up next. This is Bloomberg. Lots going on in these markets. Let's dive right into it. We are seeing green on the screen in the defense sector. A lot of this coming on the military spend. It is driving the DAX. Just take a look at some of these names here. Saab higher, Rheinmetall higher, Hensoldt, Leonardo. Rheinmetall just getting a contract from the German government as well. So that's going to be certainly one to keep an eye on. Another one, of course, is Philips. And I think this is really important here because although we are seeing this massive earnings momentum across Europe, we are seeing it on the downside as well. Philips really taking a hit this morning, down about 11%. A lot of this has to do with the growth picture, specifically out of China. They're looking at their healthcare slumping in quite a big way, weighing on their growth picture. And this is really important because their comp sales are only expanding as much as 3% in 2025. Back-ended issues expected in 2025. So in 2026 due to issues in China. That's all going to be something that we're monitoring very, very closely. Those shares down about 11%. Up next, from a brief, Danny Berger and Manus Cranny in New York. They're going to take you through the opening trades across the U.S. and the Atlantic, geopolitics meeting the earnings story. This is Bloomberg.